Hey, what's up? It's Ben here. Whether you're new to the stock market or not, these are the 8 things that you should avoid when investing in stocks. If you're thinking that the stock market is an easy way to make some fast cash, then you're wrong, especially when you're trying to get into the habit of doing these 8 things. And these are the 8 things that you should avoid and not do at all. Number 1, using your emergency money to invest. When it comes to the stock market, you should be aware that you can lose money real quick. Not all stocks are going to do well, some may even bottom out, leaving you pennies on the dollars. This is why you should never use emergency funds to invest. If your stock doesn't perform well and that you need the money for car repairs, medical expenses, or other expenses, you won't have any options but to force sell your investments even though they have taken a hit. So it's better to wait and invest when you have extra funds and that it doesn't include any emergency savings. I know sometimes when you go out and ask those financial gurus, they'll tell you the best time to invest is now. Some part of it is true, but you gotta have excess money to do so you don't have to worry about any emergencies or any debt that you have to pay back. Number 2, investing with your emotions. One of the most common human behavior in investing is getting too attached to a certain stock and not thinking through whether it's actually a good investment or not, or that you're invested too much money into something and you're just hoping that the next day it'll go back up, and you tell yourself that you're going to sell tomorrow if it goes up 1% and it never does, and you kept holding on to it and keep thinking that it's going to go up but it drops, and that really sucks. You want to get even, but the stock doesn't want to get even with you and you just end up losing. One way to avoid this is by getting rid of the stock if it starts falling to a certain percentage in a given time frame, or setting up a stop loss to prevent yourself from losing more. I've done this in the past and this helped me save thousands of dollars. You want to be emotionally disconnected with the stocks and make it more of an objective decision when buying and selling. Number 3, buying the hype. Buying stocks just because it's heavily promoted won't always work out in your favor, because it could be a pump and dump, or people are just hyping some new technology and its price per share keeps on increasing every single day and you get FOMO, or the fear of missing out, and then you buy. But when you buy, the stock price starts to go downhill because people already lost interest in it, and in reality, that company could have not sold anything. For example, Nikola, which is an electric vehicle company, and people were hyping the company so much that at one point its price per share was about $80. Then when people started to do more research on it and digging about the company, they realized that the technology wasn't even there, and coupled with the fact that they didn't even sell a single vehicle, their stock price just tanked. So just know that the flashy and hyped up stock usually aren't going to make you money in the long run, and this is especially true for penny stocks. Number 4, failing to do research. It's not a bad idea to get some opinion about a stock from friends and family, especially if they have knowledge and experience in investing. However, a person's expertise can never be a complete substitute for your own due diligence. Make sure that you're always looking into the stock that you're about to invest in. A simple search may reveal some information that you need to know and can either confirm your decision to invest or possibly make you choose a different option. I know it could be tedious to read a 10K or other report, but you gotta do it, and this will get rid of trading with emotion and just randomly buying into hype stock. If you know your research and you can support that with facts, you're more likely going to win in the long run. Number 5, being impatient. If you really want to invest in stocks, you should prepare for the long game. Most stocks simply aren't worth the investment if you're going to buy and sell frequently like day traders. Studies have shown that most people that day trade can't even beat the market, and more than 50% of the people who day trade usually end up losing money. It's better to just buy and hold and have at least a few years of growth before selling. Then you can enjoy the tax benefits and just simply spend less on the stocks. You will expect to see some ups and downs in the price, but a good stock will grow and give you a good return on your investment over time. And I would say hold it as long as you can, even until retirement maybe. Number 6, trying to time the market. The point is similar to being impatient, and it's almost impossible to time the market. You can't predict the future. The old adage of buying low and selling high is great advice, but it's not always going to work out in your favor if you only focus on timing the market. Stock prices fluctuate all the time. If you have money when the market is not doing well, then it might be a good time to buy, but ultimately it's better to invest in the stock market consistently, like every month putting money into it. This way you'll average the price out, and in the long run capturing all the highs and lows in the market. Trying to time your investment going to get the maximum profit probably won't last in the short term. Number 7, failing to diversify. Putting all your eggs in one basket is not recommended, especially when it comes to investing only in one company. Although you may start out in investing in one stock, as you start investing more, begin to diversify your portfolio. When you have multiple stocks, it protects you from taking huge losses if one company performs badly. By doing this, you'll protect your overall portfolio. You probably want a mix of investments in various companies, commodities, or bonds. But if you want to be really diversified, look into investing in index fund or ETFs, since they are usually inexpensive and have a collection of stocks just by buying it. Number 8, always looking at the stock price. You should keep an eye on how your stocks are doing from time to time, but don't overdo it, like checking up on the price every minute or hour. If so, that might just trigger emotion to start selling when it drops only a couple of percent, and then a couple of days just to find it go back up. But instead, keep tabs on the company or stock news. This way you can make better decisions and possibly have a good idea of where the general stock price is going. Plus, it does you no good trying to chase after small wins when in the future that stock price could 10x. There you have it, 8 things to avoid when investing in stocks. If you can do this, you'll become a better investor and make more money in the long run. And if you're looking for some investment apps to get started, consider opening up an account with Robinhood or Webull, since Robinhood gives you 1 free stock and Webull gives you 2 free stocks when you sign up. They do random promotion here and there, and it's free money. But anyway, if you like this video, feel free to give it a like and maybe consider subscribing for more stock related videos. I'll catch y'all later.